All right, so that's about Paul's, Popper's method of falsification. Now, if you look at this particular premise, if it is true that all swans are white, then all future observations of swan will be white. A non-white swan is observed. Valid conclusion: the proposition that all swans are white is false. So now this is a very valid thing to conclude. Okay. So again, if the hypothesis is true, then the future observations are predicted to have property X. But now you are seeing an observation that does not have the property X. So hypothesis is false. Now this is a very valid thing. Okay. You can look at this. So one thing you need to know is that knowledge keeps increasing and knowledge keeps evolving, and we have like newer and newer knowledge by each passing day. So more and more knowledge is usually kept adding. So you don't know that sometimes there can be some sort of revelation which might not be there from before. So that sort of revelations might basically change the um, decisions. Restriction of science to testable statements. Now, you need the hypothesis to be testable. If the hypothesis is not in a testable formation, then in that case, you cannot do any sort of prediction, right? So, it needs to be in a testable format. So, that is one thing. The demarcation problem, distinguishing science from pseudoscience. So one thing you need to know is that there is a difference between science and pseudoscience, right? Now science is usually backed by conjectures, hypotheses, claims, theories, and so on, whereas pseudoscience does not have any sort of those kind of rules in it. Okay. So now one more thing you need to keep in mind. If you have some hypothesis which has less information, then that is, let's say, one case. And if you have one now, if you have one more information which has more information, which one would be easy to prove as as a wrong? Now, let's say I have to prove that the hypothesis is false. Which one would be easier for me to prove it to be wrong? Now, an information-rich hypothesis makes many precise predictions about a broad range. Each prediction presents an opportunity that the hypothesis is false. In other words, the more informative a hypothesis is, the more opportunities it presents for falsification. So, it is easier to prove the hypothesis is false if it has more information, whereas it is not easy if it has like less information. Now EMH. Now what exactly is EMH? Efficient market hypothesis. So whenever you talk about EMH, you are basically talking about the particular characteristics of the markets, that the markets or the price discount everything, which means that the market is reflecting all the information which it has till date. Everything is described in the particular price. Now that is one of the things which you need to keep in mind. Okay. The term efficiency refers to the speed with which prices reflect all known and knowable information that is relevant to the future returns of the asset. In an efficient market, relevant information is presumed to be reflected in price almost instantaneously. EMH comes in three flavors. In descending order of boldness, information content, and falsibility they are EMH strong, EMH semi strong, EMH weak. So these are the three things. Now let's talk about EMH strong. Now, EMH Strong asserts that the financial markets are efficient with respect to all the information, even private inside information. So, they EMH Strong means that they are truly believing in EMH. So, they also like to say that any sort of information, even if that is something which is only known by insiders and people don't know about it, then also it is valid. This version predicts that all investment strategies be based inside the tip from impending takeover. So even information which is not known to the public, even that is reflected in the price action. So that is what is known as EMH strong. Okay. The this most audacious once again This most audacious version of EMH is also seemingly the most informative and falsifiable, because any evidence of abnormal profits from any investment strategy, irrespective of the type of information or form of analysis used, would be sufficient to refuse EMH strong. Obviously, it's very easy to show that any strong EMH is false, because if there is abnormal returns, a very, very big return on a news state, then that will basically show us that this particular news was not known to the markets before this, right? However, because information that is known privately can never be confirmed, this version is not testable in practical sense, obviously. Now let's talk about the semi-strong version of AMH. The semi-strong version of EMH makes it less informative and narrower claim, saying that market is only efficient with respect to public information. So the strong EMH says that market knows the public information as well as the private information, whereas the semi-strong EMH basically says that the markets only know the public information, and it can be falsified by evidence of market beating returns to reduce by an investing strategy based on fundamental data. So obviously you can prove it wrong. EMH semi strong denies the utility of fundamental and technical analysis. Then we have EMH weak, which makes the least bold and least informative claim. It asserts that the market is only efficient with respect to past price, volume, and other technical data. Because EMH weak only denies the utility of technical analysis. Okay, so they don't care about what news is coming in the market or what news came in the market. It basically only talks about what has happened in the past. Because EMH weak is the hardest version to falsify and thus is likely to be proven false, its falsification would generate more surprise. Okay, so I hope you understood what EMH is. You can pause it and read this if you want. Okay, now let's come to the hypothetical deductive method. What is the hypothetical deductive method? Now, hypothetical deductive method is basically it has five stages. The first stage is observation, which means that you are observing for a possible pattern or a relationship and you are noticing it, and that is done through observation. So, second stage is hypothesis. So, besides on a mysterious mixture of insight prior to knowledge and inductive generalization, it is hypothesized. So after observation, you are creating a hypothesis, and then you are doing some sort of prediction, and then you are going to verify the data, and then you are going to conclude the data. So this is how you do it: observation, hypothesis, prediction, verification, and conclusion. Now, this is how you basically take an example of the hypothetical deductive method: observation, hypothesis, prediction, then you have verification, conclusion. Okay, so now you can read this. Premise 1: if 200H is true. Now, what is 200H? 200H is basically a hypothesis where we are assuming that if the price is going above 200 moving average, then it is in an uptrend. So, you can pause this and you can read this and you will be able to understand this. Okay. So, if we had to do technical analysis using the scientific method, what would we do? The first thing you need to know is that when I talk about, let's say, head and shoulder, I might look at a head and shoulder like this. There might be a person who looks at a head and shoulder which shows like this also, which I wouldn't consider. So, it is highly subjective in nature, right? So, it is very difficult for us to basically say that which one is valid and which one is not. For example, now let's say if I ask somebody to draw, let's say if I ask someone to draw the Fibonacci in this particular chart, in this particular uptrend. Okay, I want to draw a Fibonacci in this uptrend. Now, what would I do? I would take Fibonacci from this low to this high. Okay, this is how my Fibonacci would look, right? I'm taking this particular low. One second. Yeah, I'm taking this low and this high. That's what looks valid to me. Now, if I ask someone else to draw the Fibonacci, what they would do would be they might draw from this low to this high, right? So they, instead of taking that low, people might just take this particular low. So what does this show? This shows that technical analysis is highly subjective and it can be interpreted differently by different people. So you cannot say anything. Elimination of meaningless forecast, that is extremely important. Obviously you need to be eliminating. You can read this also if you want. I'm just going through the most important things for the example. So one thing which we do when you are going to basically make the technical analysis concepts into an objective form is that you are doing the objectification of the same. So what do you mean by objectification? It means that you are giving mathematical terms to it. For example, look at this. They have basically tried to objectify the head and shoulder patterns. Okay, so they basically drew all sorts of head and shoulders and they loaded this into a particular uh, um, algo. So they showed that left shoulder should be here, right shoulder should be here, head. So they showed that how peak should be how much percentage up, and they showed that the shoulders should be relatively equal, and they also showed that there should be a breakout and there should be a prior trend going on, and so on. So all these statistical information they have loaded. You can pause it and you can read it if you want. They have also loaded how much percentage filter they need, how much percent should the high be, how much percent should the neckline be, and so on. What should be the symmetry lines? Can the head and shoulder be only like this with a line like this, or can it also be like in this particular level? So all that they have basically loaded into the particular thing. So if you look at this particular chart, this is not valid, right? Because the symmetry is not good. Here also it is not good, right? Because the neckline is sloping and it is slanting. So these are the kind of things which they basically did. Let me open the chapter and see if there is anything else important to discuss. Yeah, so that's it actually. You need to really know how to quantify the data, and you need to know how to objectify the subjective technical analysis data. And yeah, okay. You also need to know what are the subsets of technical analysis. You can write this down if you want to. Okay, now let's talk about what are the subsets of data. Now you need to know that technical analysis is basically comprised of four subsets. Okay, so if I have to talk about them, the first thing is subjective TA. You know what subjective technical analysis is. The second thing is objective TA. There will be no bias in this. You can straight up load it. And in the third, you will have objective TA with unknown statistical significance. And the fourth one would be objective TA, that is statistically significant. Okay, so now these are the subsets of technical analysis. So the first thing is subjective technical analysis, the second thing is objective technical analysis, and then we have objective technical analysis, that is that we do not know what the statistical significance of it is. And then we have objective technical analysis, that is statistically significant. So you know what subjective TA is, you know what objective is. Now we have objective TA, but we do not know what its statistical significance is. And then we have objective TA that is statistically significant.